If you're thinking about selling or moving and you own your own home, there's something you need to think about before you renew your mortgage, and that's penalties and flexibility. So you have a few options when your renewal is coming up and you know that you're not going to be in the home for the next 5 years. You can consider open mortgage products, which typically come at a higher interest rate but have no penalty. You can consider closed variable or adjustable rate mortgage products, which have a 3 months interest penalty guaranteed. So a guaranteed penalty, but is lower interest. Or you can consider fixed rate mortgages, which have a higher degree of flexibility in the term, often 1, 2, 3, 4, or 5 years. But they have the potential for an interest rate differential penalty, which can be massive, sometimes as much as 5 to 10% of the mortgage. So what I recommend considering is that if you know you're moving for something specific, like a child graduating or a work contract expiring, what I suggest is seeing if you can match the term. So if you know you're going to be selling in 3 years, a 3-year term can be ideal. But in the event that you don't know exactly when you're going to move, if it's just you want a bigger home or your family's going to grow at some point, I suggest considering an open mortgage if you're going to move very quickly, or a closed variable or adjustable rate mortgage if it's just unknown when you're going to go. And the reason I suggest this is the open rate mortgage is going to come at a higher interest rate. So if we consider what the difference in interest is between that open mortgage and the variable or adjustable rate mortgage, if we consider the penalty versus the additional interest, we can figure out what your break-even point is. If you're paying an extra, let's say $1,000 a month in interest, and we know the penalty is $6,000, that tells us that the open mortgage is better if you're going to move in less than 6 months, and the closed variable or adjustable rate mortgage is better if you're going to move 6 months or longer. Now, something else you should consider, and you have to be very careful here, is that portable mortgages sound great. You reach out to your lending rep, they say, hey, don't worry about moving, it's portable. But the key thing you need to know is that you need to requalify. And every lender has different criteria for qualifying. Always you need to income qualify. So if you're moving to a new market and starting a new job, that may not work. There's a window of time that you need to sell your home and buy a new home within to qualify. And often if you're going from an insured mortgage, so less than 20% down, to an uninsured mortgage, or the other way around, you put 20% or more and you're going to move to a new home and put less than 20%. Many lenders won't port that. So just know that porting is a chance at avoiding a penalty, but it's by no means a guarantee. So what my advice is to plan this out before you renew and have someone who's going to help you take all of the variables in your life and figure out what the best mortgage structure is so that you can minimize or avoid these penalties, because it can be really effective and it can save you thousands of dollars. One last thing before I let you go. If you look at a fixed rate mortgage and your lender gives you a penalty quote, I want you to be very careful and very cautious, because the penalties on fixed rate mortgages are 3 months interest or an interest rate differential penalty, whichever is greater. Now the problem is the interest differential penalties, because over time they can grow and they change based on how lenders adjust their posted rates. So if a lender lowers their posted rates, interest rate differential penalties get larger. And also, as your mortgage renewal or as your term goes along, they're going to compare you to different posted rates. They look at the most comparable posted rate. So at first they'll look at a 5-year, then a 4-year, then a 3-year. As these rates change, many of the major banks engineer these to cause larger penalties in the middle of the mortgage. So the quote you're given day one may not be your penalty if you break the mortgage in 8 months. So please make sure you make an informed decision here. And I would highly recommend coordinating with a realtor as well so that we can look at what the value of the home is and we can try to plan everything out to be efficient. Because at the end of the day, life's getting hard. And if we can save you thousands of dollars of money and keep it with your family rather than giving it to a bank, that's what I want to see. So if you need any questions, or if you need any, if you have any questions, you need any help, feel free to reach out. I'll do my best to be there for you.